Hi, I'm Christopher Smith,
Hi, I'm Robert Coburn.
and this is This Week at the Zoo with the Wall Street Petting Zoo podcast, your source for market news. Today, we're going to talk about some things that happened this week. Robert, we had a whole bunch of really, really bad economic data come in this week. Early in the week, we got several pieces of bad news that suggest that we may be heading into a recession. It started Monday with a U.S. manufacturing report that showed that U.S. manufacturing is at its lowest level since March 2009, right smack dab in the middle of that last recession we had. And apparently this is happening because of the trade war and tariffs reducing U.S. exports.
Yeah, Mexico and U.S. are still dealing with the aftermath of NAFTA, and of course, with all the China deals, it's kind of been not so pleasant with the stock market.
And then on Wednesday, Trump slapped Airbus and European farmers with a bunch of new tariffs too. Seems like we're picking fights with everybody right now on trade.
Yeah, maybe looking at trying to get other economies to do well. Russia.
Well, you know what? With this Europe thing, at least he went to the World Trade Organization and got a ruling from the World Trade Organization basically authorizing him to do this. I mean, if you're going to pick trade fights, that's the way to do it. You don't do it unilaterally. You do it sort of through the proper channel so that it doesn't spiral out of control, you know?
Trump going through the proper channels? What?
I know, shocker. Yeah.
I'm surprised it was just in a tweet.
I know, right?
We're asking more tariffs now.
Well, and then on Wednesday, we got some more bad news. We had some payroll data come in that showed that we added fewer jobs this month than economists expected. Also on Wednesday, the Washington Post published a report. Did you see this, Robert, about the federal government increasing our exposure to risky mortgages?
Yeah, and that sounds like something that happened around about 10 years ago.
It's basically exactly the same thing. It's even the same like Fannie Mae and Freddie Mac. They now guarantee $7 trillion in mortgage debt, which is 33% more than right before the 2008 housing crisis. There is more government-backed mortgage debt right now than at any other point in history.
Now, I have a theory about this one. So notice how California house pricing, like how much of that percentage though is California? Because keep in mind the housing prices within California have skyrocketed since 2008. So,
well, the housing prices all over the country have skyrocketed, but yeah, California is certainly particularly bad. Washington, particularly the Seattle area, is pretty bad. The Salt Lake City real estate market has been out of control. I mean, it's all over. Real estate speculation is a huge, huge business in this country.
Yeah, so it might be that there's less, like the number of mortgages may be less out there, but the amount of each mortgage is a lot more than what it used to be.
Yeah, well, just in the last few years, we have gone from we've increased the amount of risk in the mortgage market. So 57% of new homeowners with federally backed mortgages right now are paying over half their income on their mortgage, which is like the level that the federal government designates as a high risk mortgage. And that's 19 percentage points higher than just 2 or 3 years ago. So not only do we have more mortgage debt than ever before, but it's way riskier than it was before. And this, again, is exactly what happened in 2008, right before the recession. So with all this risk in the market, here's how the next recession starts, Robert. If the job market were to slow down even a little bit and unemployment were to tick up, people were to start losing their jobs, you see a cascade of people defaulting on their mortgages, banks losing liquidity because the mortgage market bottom is falling out of the mortgage market. And it happens just like it happened in 2008, where banks start to fail essentially because everyone's defaulting on their mortgages again. So all it would take is a job market slowdown.
So would reducing the interest rate again by the Fed help by the end of the year? that everyone was hoping
I
on?
mean, it could help in the sense that it might help companies. I mean, basically, what that does is it makes it easier to borrow money, right? So if it's easier to borrow money, people can borrow at a lower interest rate, then you'll have more people getting mortgages, more people borrowing money to get cars, et cetera. So that could help companies continue hiring into the near future. So, but basically, what that's going to do is just prop up the economy a little bit longer, right? We're adding more debt, and the next recession is going to be that much harder when it hits because there's going to be that much more debt to blow up on our faces. So I think that will sustain the expansion a little while longer. It'll stave off recession a little while longer, but it's not solving the problem. It's actually making the problem worse over the long term, you know?
So why not just make the interest rate zero?
Um, I mean, you could make the interest rate zero, but then if a recession hits, we don't have any tool to like stimulate the economy. You know, Uh, having a higher interest rate gives you the ability to adjust that interest rate when a recession hits. So if we use up that capital before the recession hits, then when the recession does hit, we don't have anything left to do to help, make it lessen its impact.
Yeah, we just print more money,
Yeah. I'm worried about it, Robert. I saw I saw that report and I saw all of this bad economic data that came in this week, and it's looking bad. I really think that when this next recession hits, it's going to be worse than the last one.
Yeah, it's definitely all the signs are there. It's just a matter of how many companies and how many people in general have recession-proofed themselves since the last recession 10 years ago. So it'll be, hopefully it's not a roller coaster. It's just a small little blip on the radar, but based on all the signs, it could be a giant crater.
Yeah, one of the things that the Trump administration is doing right now that I agree with, but it may be too little too late, is that they are trying to remove some government regulations that prevent Fannie and Freddie from accumulating a cash reserve. They're supposed to, basically, these rules are supposed to keep Fannie and Freddie loaning the money out rather than hoarding it. But if they don't have a cash reserve, then they have no resilience when that mortgage crisis hits, right? So it just makes them more vulnerable to a collapse. So they're trying to remove those regulations so that Fannie and Freddie can start accumulating a cash reserve to give them some resilience against that. So that's, a step in the right direction. But ultimately, I think this whole real estate market has to be scaled back a little bit. We've got to stop some of these high risk lending. And basically, we've got to rein everybody in. But this is one of the only segments of the market right now that is growing and adding jobs. So when you have a weak manufacturing sector and a weak retail sector, it's really hard to sell anybody on pulling back the financial market or the real estate market when those are the only parts of the market that are growing.
Yeah, so if there was a recession, and since mortgages are at the forefront of that, would housing prices go down after the recession started?
Yeah, I think absolutely they would. It would be harder to borrow money for a mortgage. So because people are unable to borrow money, the demand in the real estate market falls off. And there will be a lot of supply because there will be a lot of houses being foreclosed on, and those will all be getting sold off. So I think just as a matter of supply and demand, you will see housing prices collapse just like they did in 2008. And so that will certainly be an opportunity for real estate investors who have cash saved up to swoop in and buy up a lot of property really cheaply.
You hear that, California? We're going to get discount houses.
Yep. Yeah. In fact, Robert, one of the main reasons that I right now am pursuing a day trading, swing trading, short-term investing kind of strategy is because I don't want to be in the market until the next recession hits, because I think it's probably not that far off. And so I want to have my money in cash ready to invest when the market, sort of bottoms out in the middle of the next recession. Because it really matters what price you enter the market at. If you enter the market if you wait until the price of whatever stock or security you want to buy is half of its current price, then when it comes back up, you've just made 100%, right?
Yeah.
So moves down tend to be a lot sort of, they'll hurt you. If you lose money in the stock market, it hurts you a lot more than when you gain the same percentage. Like 1% move down is actually bigger than a 1% move up. So it's really important to get the best entry price. So that's what I'm waiting for, is that entry price.
Yeah, I mean, that's how Warren Buffett made a lot of money after the recession, too, is that he basically, when everyone was pulling their money out of the stock market, he was putting more money into the stock market. So that's one thing that's good to have during a recession is cash, because then you just want to just throw it at the stock market at that point.
Yep. And my girlfriend bought a house. Well, she bought a condo in 2013 and sold it last year for, a really nice, like $80,000 profit. So there's definitely a lot of money to be made there if you've got some dry powder when the recession hits.
Yeah. And when I say prices. Cash, I don't mean like Bitcoin or cryptocurrency, because that's typically tied to, I think those are tied to like gold markets. Like when gold is doing well, crypto's doing well, or when gold is doing bad, crypto doesn't do as well.
There's definitely some correlation there. So the way that it works is like the dollar is what you trade for either gold or cryptocurrency. And so when the dollar is weak, you can basically get more dollars for your gold. So anyway, both crypto and gold tend to move opposite the dollar. So if the dollar is weak, then gold and crypto are strong. And if the dollar is strong, then gold and crypto are weak. The dollar tends to be stronger when the market is strong. But if the market gets weak and then the Fed cuts rates, then the dollar gets weak. So, and gold and crypto get stronger. So anyway, basically, if there were a recession, probably gold and crypto would be good places to have your money. I'm not really sure how crypto would perform, but I know gold would be great in a recession. But I suspect crypto would be similar, that it would do better during a recession.
I know Bitcoin's down 33% from their year-time high of I think it was like 12,000 was like the high per Bitcoin, and then right now it's floating at about 8,000 as of this minute, around there.
Yeah, this is the thing about crypto, is that it doesn't follow predictable cycles in relationship to the market. I personally wouldn't invest in crypto. It's basically driven by like how much hype is there in the market around this technology at any given time. It also potentially could be driven by cyber criminal activity, like if Russia's doing a lot of hacking and a lot of people are paying ransom to get their computer information back, that might inflate the crypto price. But like, this is not something that actually has any real value. So it's not something that I personally would want to invest in.
I've invested in Bitcoin for a little bit.
Yeah.
I usually about every other paycheck I'll throw like $20-$25 at Bitcoin, and I luckily was able to buy some earlier in the year when I think it was down to like six or 7,000 per Bitcoin, and then by that time by the time it ballooned up to like 12,000, I had a quarter of a Bitcoin at that point. So luckily I was able to pretty much double my money, and then I just pulled it all out, and I'm actually thankful I did, because then it went back down to like 8,000. It's kind of been like fluctuating between 8 and 10,000 per Bitcoin.
Yeah, I think we're closer to 8 right now, and honestly, I don't think that it's going to come back up. It might. Hype is unpredictable, but we've now had 2 big Bitcoin runs, and then come crashing back down after both of them. I feel like at this point investors should have learned their lesson, but I don't know. We'll see.
Nah, if you read a Walk Down Wall Street, nobody learns their lesson. Everyone's just a glutton for punishment. Everyone just wants to repeat history.
It's amazing, isn't it? So back to the economic data, we did get another jobs report later in the week, we got on Friday a government jobs report that showed that we added fewer jobs this month than economists expected, but it was not as bad as the payroll data earlier in the week. We only slightly missed the economist estimates on how many jobs we were going to create this month, and we actually hit a new low for unemployment. We were 0.2% down in unemployment, a record low, and the jobs number for August got revised upward by 45,000 jobs, which is a lot. So this report seemed to suggest that the economy is in a better place than some of the data we got earlier in the week. A lot of news agencies were reporting this as a positive job report. We got a nice market rally on Friday on the strength of this job report. But when you really drill into the numbers, it looked a little bit more concerning. First of all, wages declined in September. So it looks like companies are cutting costs by hiring more part-time and low-wage workers. So the jobs numbers aren't going down, but the wage numbers are. And secondly, if you look at where the jobs are being created, it's education, healthcare, government, finance. It's some of these bubble sectors where costs are too high, and we really need to be scaling back costs in those sectors. They're funded by debt. Education is funded by student debt, healthcare. There's a lot of medical debt. Government, of course, we're doing a lot of deficit spending in government. So these are just they're not sectors where we're creating things. And the core of the economy, retail, manufacturing, mining, we're actually losing jobs in those sectors. So it's the unskilled workers working in retail and manufacturing who are getting hurt most by the trade war right now. And it's sort of the debt-funded sectors that are still growing. So I'm worried right now that the job market, that our resources are not sort of properly allocated in the job market, and that essentially the continued expansion of the economy is entirely funded by debt. That this is not signaling real economic strength in America. It's just signaling that we're borrowing against our future. So I'm concerned. I don't think a rate cut is going to save us right now. I think what we really need is a resolution to this trade war, and we need some correction in the mortgage market. We need to impose some new controls on all of this borrowing that we're doing. And if we don't do that, I think we may be entering into a new recession. We did also get a signal on Friday that the Fed is looking at a rate cut. Jerome Powell made some comments about how it is the Fed's role to make sure that the economy stays in a good place. So that would be great for gold. A recession would be great for gold. I think right now gold is a pretty good bet. So if you're going to invest, that would be a good place to invest. But I've got a lot of my money in cash right now. Actually, after the market rallied on Thursday and Friday, I closed out several of my investments, and I scaled down I had about $10,000 invested, and I took it down to about $4,000. So watch out there, guys. Be careful.
Gotta hoard all your money. Wait for that crash.
That's right. Oh, one other thing that happened this week was we got a report on the trade deficit that showed that the trade deficit is worse than it's been in a long time. We increased the trade deficit again, which is another warning about the impact of the trade war on manufacturing. And then there was the Schwab and Ameritrade news. You want to talk about that, Robert?
Yeah, so this week Charles Schwab and TD Ameritrade announced that they're going to be doing commission-free trades, which a couple weeks prior when we mentioned with like Robinhood and Webull that one of the benefits that they have is you don't pay commission fees when you do perform trades, which basically means you're not paying $5 per trade. So if you buy into index fund or any type of stock, you're not potentially spending $10 total for buying in and then selling. So some are saying that this may not help their in their battle against the newer incumbents with Robinhood and Webull because they're still in their older model. They're not new and shiny. That millennials and Gen Zers are more likely to tend to move towards.
Well, we're going to have to do another Pick Your Trading Platform episode, Robert.
I think we should just do one just on trade platforms in general and basically look at them. But we also have to look at the logistics of what we can and can't show, because I think on some of them they might have some like NDAs on like what you can and can't publicly show, because some of them require logins, like Fidelity, and all of them require logins. But to look at some quote information, you need a login for that, and so we got to look through the TOS for those.
Yeah, we'll have to do a little research, but definitely I think this could be a game changer for a lot of people. I haven't used either Schwab or Ameritrade, but I suspect that they have a really nice suite of analytics features for their users. And so, I think that it's definitely worth looking into for us. And if these companies, I ran some numbers. I figured out how much of Ameritrade's revenue is coming from their commissions on investment products. And I looked at what are their earnings, and if you subtract that revenue from their earnings, how big a hit are they going to take? And what I found was that their earnings should basically drop by 27% if you subtract that revenue. So their stock price took a big hit after they made this announcement about commission-free trades, but it was commensurate with that 27% drop in earnings. They dropped about 27%. So, but the thing is, they could actually increase their revenue if they can steal customers from Robinhood and Webull, and then those new users, if they can find a way to convert those new users into customers for their banking business, they could potentially increase their revenue in other areas besides commissions. So it's all going to depend on, can they find a different way to sort of monetize their user base for investment products.
Yeah.
And I think they will figure that out. So I think that Ameritrade stock and Charles Schwab stock will come back up once they figure out a solid way to monetize that.
Yeah, and traditional stockbrokers are saying this is a bad idea on Charles Schwab and Ameritrade's part, because they're essentially saying that investors are now going to, or individual investors are basically going to not make, or they're going to make more knee-jerk reactions. So in other words, they're not going to sit and think before they make trades, because they don't have that $5 fee waving in their face. But I mean, I don't see a $5 fee waving in someone's face preventing them from, making a decision when it comes to, thousands and thousands of dollars of their money. So I don't think that's a correct assessment on some of the stockbrokers' parts.
Well, having traded on both Fidelity, which has commission fees, and on Webull, which does not, I have to say I've probably made better decisions on Fidelity. I think there's some truth to that. You hang on a little longer. You're not going to do so much of the micro trades on the trading platforms with commission fees. Well, so it probably will increase the volatility in the stock market if people are making more micro trades.
For me, with Fidelity, it was the opposite, because instead of trading, one stock of one thing, I was trading hundreds of shares, because you want to minimize the impact that trade fee has, because the more volume of stocks you use, the less the stock ticker has to move in order for you to make or lose money. So for me, it was the opposite. I actually ended up not doing as well as I'm doing on like Robinhood.
Interesting, because you're taking on more risk for each individual trade.
Yep.
Yeah, that makes sense. See, one of my problems is that I exit my winners too early on the commission-free platforms, because I see a small gain and I'm like, okay, that's enough, and I'm satisfied with that. But if I stayed in a little bit longer, I would make a lot more. And on the commission platforms, I stay in longer because I got to cover that commission and also get some extra profit, so
you can't get mad at yourself for ringing the register. As long as you're making a profit, that's what matters.
Well, you got to be, if you're taking small profits, you can't be taking big risks, if that makes sense.
Yeah.
So you've got to be ringing the register when you see a loss as well as when you see a profit. Basically, it has to be commensurate on both sides, because if you're occasionally taking like a 50% loss on a trade, then you have to be making on average a lot more on profit per trade if you're going to be taking those kinds of risks, if that makes sense.
Yeah.
But so let's look back at our stock picks actually from a couple weeks ago. How'd your stock picks from a couple weeks ago, Robert? How'd they do?
So pretty much all of them haven't really done anything in terms of after they announced their quarterly earnings. Like FedEx, they kind of just flatlined. And when I say flatline, they pretty much didn't really go up, didn't really go down. They just kind of stayed about the same. Not that they died flatline, but same thing with Adobe. I mean, Adobe went down. It dipped about 10, 15 points on that jobs report earlier in the week. And then it came back up on Friday when that other jobs report came back. And other than that, Herman Miller, that's been, it's actually been going a little bit. Nah, that one actually went down. And then General Mills, same thing as Adobe. It dipped on that bad news on Monday and then rebounded on Friday. So everything pretty much is more or less the same as what it was when we first looked at it a couple weeks ago.
Most of my picks have held pretty steady as well. I had Microsoft was one of my big picks that, it's down like 1% or something like that. But most of them are kind of in that range when they've only moved a percent or two. But I did have one big loser and one big winner. So my big loser was Eros. I don't know if you remember the Bollywood production company that signed a bunch of streaming deals, including one with Microsoft. This is one that I predicted would hit 350 the following week. And it did go up on Monday. It hit 338, which was up substantially. I think that was like a 10% gain. And I actually got out at 338, which was pretty much the top, but then I re-entered lower. And unfortunately, it fell hard after I re-entered. The news came out that they were taking a $27.5 million loan. Basically, it's called senior notes, but it's basically like a corporate bond that's going to be due next year. And this is something that sometimes happens when companies announce a new product launch. The stock price will soar on news of the new product, but then the company has to finance that new product. So they either will take out one of these corporate bonds or they will issue a bunch of new shares, which dilutes the value of the shares that are already in the market, and the stock price plummets. And that's what happened with Eros. The stock price plummeted from, like $3 to $166 last I looked at it. So it's down over 50% from its high. And I do fully expect this to come back up in the long term because their Bollywood content alone, I read an analysis on Seeking Alpha that said their Bollywood content alone is worth between $1 and $2 billion. So if you run the numbers on their market cap versus the value of their content, their market cap is like 320 something million right now. So this company is way undervalued in terms of the stock price. Fair value of the stock is somewhere in the $5 to $10 range just on the strength of what their content is worth. So, this will come up in the long term, but it will take a while. I'll be holding on to this one for quite a while, probably before it comes out.
Oh, I'm writing this one down right now because the long-term investor in me is like, wait, you're saying this thing is worth what?
Yeah, well, if you are going to enter, Robert, I would suggest waiting until Tuesday because Tuesday pre-market, they're going to announce their earnings for the quarter. And they're announcing earnings late this quarter. And companies that announce earnings late tend to do badly on earnings. This is kind of a hidden signal in earnings dates. Companies that report earnings earlier than usual tend to do better than the market expects, and companies that report later than usual tend to do worse than analysts expect. So the earnings could be bad, and the price could drop to its low around 114. So it'd be an even cheaper entry if the earnings go bad on Tuesday. But yeah, just subscribe to their investor alerts on their website and check out that earnings report and kind of see how they did. And then make your decision about whether to get in or not. That'd be my advice. Then my big winner was Avaya. And this one is like a business-to-business technology company. And I talked about this one a couple weeks ago. It got a bunch of analyst upgrades. And I wasn't really sure what the analysts were seeing, but I could see this company looked like it was pretty undervalued, like it might have some product launch catalyst coming up. Well, it finally did get a product launch catalyst this week on Friday, actually on Thursday after market. They announced an alliance with RingCentral to offer a new VoIP call service, VoIP calls. And so it was up like 15% after market on Thursday, and I exited there. So I took 15% profit. I'm pretty happy with that. But on Friday, it came up even more, and it ended up like 30% from its close on Thursday. So I could have gotten double the profit there. But like you said, you can't give yourself too much grief for ringing the register at a profit. So really, really nice results from that one there.
Yeah, so coming from a technology background, this is actually a big and good move for Avaya's part, because they've been hemorrhaging customers for a while, and a lot of the hardware companies like Broadcom have actually been hemorrhaging companies, because like the newer incumbents that are focusing on a software-based VoIP solution have been displacing some of the hardware folks that have been out there, because it's a lot easier. You don't have to have like a physical phone on your desk to make business calls. You can actually just take it with you, on your laptop, or even some of the better ones is you can actually install the phone app on your cell phone, and with the Wi-Fi connection, you can make business phone calls without actually using your normal cell phone number, which is really nice. And Zoom actually just recently came out with their soft phone in November. So, and Zoom has been doing phenomenally well. They're highly reputable. So this is a big move on Avaya's part. Avaya is already like a huge name in the VoIP industry, and I think this is a correct move to partner with RingCentral, with RingCentral's like soft phone offering.
The market certainly seems to agree with you, Robert.
Yep.
Yeah. Well, so what are you watching this week? Anything?
This week, what was the stocks I was looking at this week? I was going to continue to watch Activision Blizzard. I think, what was it? BlizzCon's coming up soon. So I have a lot of money invested in Activision Blizzard. So I'm really looking forward to seeing how their stock is going to perform this week with BlizzCon right around the corner. And for those that don't know, BlizzCon is like their own convention that they run, where they announce new IP expansions for their current content that they have, and essentially it usually determines how the rest of their year will go financially, because a lot of the reactions to the market are going through that. Also, Call of Duty, which is like one of their main bread and butter IPs, is releasing their new game this week. They already released the mobile version last week, so a lot of big things for Activision Blizzard. A lot of people are saying that their stock is currently undervalued, and they're looking to hopefully get it back up to, I think it was like 65 is the target. Right now it's only at about 52, 54 as of Friday. So
one of the sectors that's adding a lot of jobs right now is entertainment.
Yeah, esports in general as well. Like the esports field is growing. I think it's supposed to grow up to 20 billion by the end of 2020.
Yeah, that doesn't surprise me. That's definitely a booming industry.
What stocks are you looking at?
So I am watching gold, because we did get those signals that the Fed may cut rates again. So I think that gold should do fairly well this week. Although after market on Friday, there seemed to be some weakening of expectation of a Fed rate cut. I think that morning it had been like the market was pricing in like 90% chance of a Fed rate cut. And then after market, it looked like they had scaled back a little bit. They decided that the jobs report was too good, so maybe the Fed wouldn't cut rates, and so it was down to like 78% likelihood of a Fed rate cut. But that's still better than even chances of a Fed rate cut. So I think that gold will be up next week. It might pull back a little bit Monday morning, but then I think we'll see it pop. The other thing that I'm watching is oil. So oil has been down, down, down all last week. It had a really bad inventory report that showed that supplies of crude oil were increasing in the U.S., even though a lot of producers have cut back their production. So I think that we've definitely got kind of oil at trading at a cheap level right now, and we hit a floor. We hit what's called a support level on Friday. And in addition to hitting a support level, we also saw in the Friday jobs report that the energy sector is one of the sectors that's actually adding jobs. So it looks pretty good for the energy sector in that jobs report, which was actually surprising given how weak oil prices have been lately. So I saw a little bit of a rally on Friday. And in fact, at the end of the day on Friday, it broke my trend line, which is usually a really good sign. So I'm going to be watching this pretty closely. I may get in Monday and Tuesday just to get kind of the bounce from that support level. And then I'll be watching real closely on the inventory reports on aftermarket Tuesday and Wednesday morning to see how they come in, because if they come in good, then we could see a really, really nice bounce in oil. So those are the two. I'm basically looking at commodities this week, not stocks. I think that stocks got a little carried away on Friday when the market rallied. I'm worried about these Fed rate cuts in part because I think the market is trading above where it should be based on the weakness of all the earnings reports. I think that the market should be down quite a bit, but because investors are counting on these Fed rate cuts to save us, I think the whole market is trading sort of above value right now. So I don't have a lot of money in stocks right now, apart from Eros and a couple that are sort of cheaply valued.
Holding on to that cash, being Uncle Scrooge. Right.
Yeah, commodities are usually a pretty good place to be in, as we enter a recession. So
because those are backed by physical things.
Exactly. Yep. All right. Well, everybody, I think that's our news episode for the week. Keep in mind that we are not registered investment advisors, so this podcast is for educational purposes only. If you're going to put your money in the stock market, I would suggest checking with a real registered investment advisor, somebody who's legally authorized to give you stock trading advice. Make sure that you like, comment, and share below the video. That supports our podcast, helps us get our name out there, get noticed by a lot of people. Like us on Facebook, follow us on Twitter. Our Twitter handle is WSPZoo. And we have a referral link for Webull below the video. If you click that link and go sign up for Webull, add $100 to your account. That helps us support the podcast here. Thanks so much for listening, everybody, and hope to see you next week at the zoo.
See you next week.